Okay, so let's start. Uh, Thank you all for coming and thank you for attending online. Roosevelt is not with us tonight. He's with clients Switzerland, and it's the first time that he misses the event, and we miss him. Our club has we run 13 groups in multiple countries. We have more than 6,000 members, and our main event is here in London and Milan in London. So you can go on City Falcon and Meetup, and you can see all our previous um, presentations from the previous meetups. City Falcon slash Meetup. And also here, uh, you can see the performance of the ideas presented. I'll just bring that a bit vertically. Yeah. So now I think that you can see. Okay. So basically, I want us to talk about our performance this year. Uh, does anybody want to talk about his performance? About what? Okay. So basically, what we see here is that the S&P 500 has declined year to date. It's about 20%. It's about 20%. Okay. So, do you think that most people perform better than that or worse than that?
Quite a number of
Yeah, please help me with my close the microphone, please.
Yeah, well, obviously it's an average, but presumably most of the smaller people will be performing worse because they'll be not as experienced as the large people. Probably a greater number of performing worse.
Okay. So,
I don't think it's okay. So go on.
certainly.
Yeah.
Anyone else? Anyone else? Okay. So, uh, yeah, what I have seen is that we, value investors, value investors, we have done well this year. So compared to that, I think that most of us are close to break even. Yeah, and we can see that here. So year to date, you know, we see the S&P 500, which is what's kind of silver, okay. So this about 18% down. The dark blue line is S&P 500, and then if you go for the Nasdaq, I mean, where when you go towards where most of the people go, like when the trend or what the momentum is, you see that the performance is getting worse. So if we get the fund of Catholic Wood, for example, we see that it has a performance of 62%, and Nasdaq again with stocks, it's minus 29%. So we see that people that they were not in that trend and momentum investing, I think they have done better. This one, the purple line, is a value fund. It's a Vanguard value fund. You see that it's almost break even. So from friends that I have, I think that most value investors are around this. Is that true? Do you have the same opinion? And now, if we go and see how the situation is for the 5 years, we have an even like better picture. And something we can notice is that those that, for example, have picked, yeah, sorry. Okay. So we see that they started feeling the pain, since 2001, since the start of 2021. So for 2 years, they have been, experience. We cannot see here the amount is not so negative because during the 5 year period is not so bad. But if we see for the 2 year period, we see that they have lost around 70%. And I think a large majority of the people that they have got into the stock market is making, the new generations. The profile of their investor is similar to that. So there must be a lot of distractions. Any opinions on that? Any comments?
I agree.
Yes. Yeah. So, okay, if you see this graph, somebody can say, okay, it's so obvious. They just went to something that probably was public, and it seems now that it's so obvious. But it's like if you came and said this thing 2 years ago, if you were a value investor, you would be like an idiot, and you wouldn't be able to persuade anyone. Whatever arguments you will have, they will say, you know what, look, we know what we are doing. We are going up. And with what you say or what you do, you just have this low returns. And it's something that it's always difficult for value investors because they have always to keep themselves outside of this party. And if we go further back, we see something that it's why I'm showing the 8 year graph. Because something interesting of those situations is that a few years of badness, let's say, can affect massively the performance, the historical performance. For example, some years of good return go and affect the historical performance. So somebody then can say that for the past 10 years or for the past 20 years, so always the market um, makes you understand the opposite of what you should understand. It has this way that when things are going like that, it tells you that, even in the past 10 or 20 years, this is the right thing to do. Even if you go into back tests for longer periods, you have this type of, it's the time, what's the time? So what's the solution, do you think, to this time? How can somebody understand if this increase in prices is a battle or it's a, do you have any ways of how somebody can understand that and make this distinction?
Now, as long as you can actually shoot develop credit face balance sheet without challenge with martial.
But let's say you're like there. How can you know that this is a good investment or it's something bad? Not. Any other opinions?
It's like this is after it's trying to compare its underlying signal
Purchasing. So our plans lost ways to screen different value. Something has gone up so much, you should actually be cautious. Don't buy anything else. Price goes up, demand comes down, but the financial assets it seems to be that when price goes up, often demand goes up, which is totally irrational. Exact opposite.
Yeah.
So it's just, if you just behave like you would behave if you go buy groceries, don't behave in a different manner, then you may avoid problems like this.
Anyone else? Because I think we made a good point. Anyone else? Okay, so let's go to the next slide. So I think that this is like a good way of thinking. Do you know what is the cyclical adjusted PE? It's otherwise the Singer's PE. Who wants to say what it is? Say it. Okay. Alex. Okay. Say it. Okay. So basically, it's like the P basically it takes into account the average of the past 10 years. That's just to smooth the P. And basically, if we get a multiple, so some of them, the dark green line multiplies this earnings power. For example, if you're a company or for an index, we get the earnings. We have earnings that the company has produced for 10 years, for example. We make an average, and then we multiply it by 10 or by 12 or by 14. We get the earnings power, and then if we multiply it, we get a sense of value. And when a business trades close to 8 or 10 times or an index, what can produce on average, we say that probably historically was cheap. And then when it trades for 20 or 30 or more, probably it's a bubble. So I think, and tell me if you agree with me, I think if you're a real investor, you really focus on the rainbow. What happens when you see the rainbow goes up? The rainbow is the real value. The line is just the price, and it shouldn't affect you when it goes up or down, meaning that you are reaching. The real value, what you need is the rainbow. So if you focus to the rainbow, you can understand all those things. And this comes from a very good site you get in the stocks.com. It's from John Kingham, and we use this graph from his blog. So basically, one of the best things that somebody can do for a specific company or for an index is to behave in a different way than the others. So if the others, for example, here see a straight line, we see a straight line, they see just the price, you can see that underlying you have growth of earnings. Your businesses really worth more. They are worth more. And if you look at it that way, the fact that it's a straight line shows that now it's worth it. So you have two factors that they're working for me. One is that the earnings, and the other thing is that the multiple got lower. So I think that one way of checking if you are in a bubbly or not in a bubbly situation is about seeing if your performance is coming from what your businesses do or from just the multiple. If it's just multiple expansion cannot continue for forever. Any thoughts on those things? Because for wanted to be a discussion, we are a few people, and it's nice if it can be a discussion. Yeah.
Okay, well, like I said, this graph really shows the FTSE 100 terrible expensive levels. It's a terrible index. It's about terrible companies. And I think that is what this shows. But index digitalized and it didn't go.
But if we through the very last period, I think that one reason that it has done very badly is because it used to be overvalued and some part of this that maybe we see some slowdown in the real value.
just say like the graph. You look, 1999, avoided entities. Let's see, like avoided fixed up on the crash through ratios. And every course entities in 2008 went into a green, the base, and again, during those in 2020, I would have made significant gains. But just looking at Iran, it's historically proven accurate and I don't even have to have an ability to make the start of my story. But if we're using that, okay, right. Yeah, that's nothing what happened. It's the
They struck. Yeah. Now we are going to present ideas and Alex will present Zytronic. I'll present some retailers. Have you ever used to be part with some tools? Yes, so basically, you see here our watchlist. So for the stocks that you choose, you can have news, and it's a nice way. We filter those news that they are relevant, and it's a good way of tracking the companies or things that they are you're interested in. And that's what Buffett says.
Hi everyone, this is me, and this is one of my favorite stocks. Just for disclaimer purposes, I have about £50,000 this company.
Alex, if you want to come closer to here, because they can hear you better. If you want to come from this side, anyways, I won't show the camera.
I don't diversify too much. I like to have a concentrated. I like to really know what I know, so I do deep diving. So, anyways, let's get moving. So, Zytronic is a company that I purchased 6 months ago. Even though this is £1.60, but my average purchase price is about £1. So I continue to buy it on the way down. I think currently it's trading at £1.30. So these figures are slightly out of date. The market can slightly less. We have a rate of discount. So basically, it's a developer, manufacturer, supplier of touch screen. They put digital touch screens into customized products. It's based in the UK, microcap. But it's got enough liquidity where you can buy 5,000 a day, maybe more. It wouldn't really affect the markets. So at £1.60 per share, the whole company is worth 16 million on the market. But fundamentally, I think it's worth far more than that. So that's just basically who owns it. Just a bit of detail here. We won't change the slide. Yeah. God's sake. Dimitri, it won't let me change the slide. It won't let me change the slide. Wait. So, see, this is a summary. I don't have too long, I have 20 minutes to go through it. Basically, Zytronic struggled through lockdowns, for the export business, the Finland trade for a country. The good market overseas, and still a bit close to the line. They also struggle to source electronic components. But despite the lockdown, they made a tiny drop of 290,000. And then in 2021, they bounced back with a full profit of 210,000. Now, During this difficult time, management repurchased a lot of shares. They repurchased 36% of all outstanding shares. The tender offer, they repurchased significant amount of £1 in July, and then they've done subsequent repurchases of slightly higher prices. So if you find buying a price even lower than the management bought at, that means that in the future, when earnings return, which they're likely will, Zytronic have made profit every morning since 2006 to 2020. Been making about 2.2 million per year. That means that in the future, you'll have a higher percentage ownership in the company. So the management having solvency in this themselves, given the company is halfway on the value. So this is a very simple company that has no debt. Its market cap 16 million, it has 7.5 million in the company. And then also had a lot of property which has been mortgaged. It also had overdraft facilities and so on. So it's very unlikely to go bankrupt. So the downside is very low. I did an analysis of the balance sheet, and basically the land and buildings is stated at historically cost minus calculated depreciation. A lot of land and buildings is still historical in the last 2009 during the financial crisis when houses fell, and they've gone up subsequently quite significantly. That happened before that 2000. So that's vastly understated. So when I do the liquidation value, this later, the liquidation value is about £19 million. So you can buy the whole company in about 12, 13 million today, and you could liquidate the company in about 19 million. So to me, that makes it fit. Also, it's a strong going concern. For the last 7 years, it's just for 1 year it made a loss, and 1 year it's tiny loss. So basically, I think that Zytronic has gone through a tough time. I think that it will reverse really, and I think that profits are likely to be cut, but the business is essentially the same. I think the factors that have affected it have been external and sentiment. I don't think that Zytronic has a lot of people in the future. So just get through. Okay, so why has Zytronic gone down? It's gone down because they couldn't profits fell significantly. People take that trend line and then steadily extrapolate it into the future. It's going to continue forever. They're going to be on three. That has happened in all 90 years to persist. Also, they took the dividend to zero, which was great, I believe, because they had a huge cash balance. They didn't have to. They lowered the share price further because the other investors. Then they used that cash to buy back shares. They an undervalued price. And they went big. I went to just buy back a few shares and get back rather than further the company. Going to the slide. Basically, as you can see, Zytronic is an exporter of touchscreens. 96% revenue comes from overseas. It's a very simple business, which I learned. This one line of business, revenue, cost of sales. They had some exceptional costs, but that's expected because of the pandemic, and so on. The gross profit margin has been historically quite high. Over the last 10 years, it's 37%. Margin, they've got things of economic moats. They've been in business for a long period of time. So here's the financials. You can see that they have no debts. They receive hardly any interest. So it's a very simple financial statement. Thing of concern there. It's very easy to understand, which is something I like. But I don't have to understand multiple businesses. I just have to understand business. So I want to keep things simple, then I'm less likely to make a mistake. So for me, it's important that the company is well run and that the management have integrity. So, as I said before, since 2008, since 2004, Zytronic's been profitable. But Mark Cambridge became CEO in 2008, and he's made a profit every year, except for September, well, year ending 30th of September 2020, because of lockdown, the little tiny loss. So you can forgive him for that, which you really do. As you can see, management have, slightly cut their remuneration, which is a sign of goodwill. You can see they don't have a huge stake in the company. They have inside ownership. So I think they have some ideas, and then that's increased because have a great percentage of ownership in Reitmans. If you look at the long-term record, which is something I'm more interested in the long-term record than the short-term record. If I add back, the cash flow, you would have seen that book value would have increased by 15.68% a year since 2010. So that's good business. So, and that includes the time value of money. I basically entered those flows into my calculated, then they I don't know how to do it on the Excel spreadsheet. So, I like a business that's very good with communication. So, this is something Zytronic's done very well. Unrelated business with a large cash balance. They haven't repurchased shares at inflated prices. They haven't paid out except cash dividends. They had a big cash buffer. At the same time, they have a very good return on invested capital, 33% over 4. It's a good business. I really like that they repurchased stock shares. The price they did. And the reason I like that is because if you look at the market capitalization, you can see Zytronic is worth 100 million not very long ago in 2017, and now it's trading at 12. If you look at also they're purchasing those shares at roughly book value, and more than half of that book value now. So. Also, if you look at when they purchased property, they, invested a significant amount, 3.5 billion for a school, and they invested it at the perfect time. Now I've talked to the insider, he told me that they have a contrarian ten, like that they have a value set, and that they act decisively, and in a big way, opportunity arises. So you can see there the amount of property they bought when they bought it, which is very useful. Then you can see when they listed the company, they listed it in July 2000, which was, it's not another thing, they could have listed it during the .com bubble. But they got a good price for shares. So when they're buying shares, they're buying them low. When they're selling shares, they're selling them high. I like that. So if you look here, they could have easily moved from a small lot to a small profit. Accounting maneuvers, provisions, moving revenue from one year to the next. They could have done that, but they weren't so concerned with massaging the numbers. I know a lot of companies, if they have the ability to do that, they do, because I know that if a company makes a lot, the share price reacts in a much more exaggerated manner. When I looked at their exceptional items, they haven't put anything in there that's actually recurring, which is honest. I look at the correlation between net income and cash flow, it's strong, which is an indication that there's no shenanigans going on. When I read the accounting policy, they seem very standard. Nothing was. They've received a clean audit every year, no major restatements. There's nothing new coming into the financial statements. So it's like a deep dive, actually really understand everything that I'm missing. Sometimes, you can have a great company and then you actually in a small print in the in the notes, it raises a red flag because the way they're accounting for something is actually not compliant or succeeding in some manner. So this is the part I think I'm weakest on. Just really understanding Zytronic and how it competes against others. Zytronic's a very small company, it's a niche company. So Zytronic has 9 patents. I think it has 6 more patents in application. That gives it some sort of intellectual property protection. They've been in business for a long time. They've got a good reputation. My own that they've in the past. They offer a niche product. It's like customized for particular individuals, companies. The thing that's negative, I'm not trying to sell the stock, I'm trying to be objective about the company in the future. One thing I would say is they have limited reinvestment opportunities. Like revenue has grown slightly over the last 20 years, but it hasn't grown a lot, and they've had a lot of cash on the balance sheet for quite a significant period of time, and if they had reinvestment opportunities, they could have utilized that. So obviously, there's some limitations there. Also, some customers have a significant portion of revenue, especially at the moment. So if they lose a customer, that's a significant decline in revenues. Also, if one customer knows that they are a big portion of your revenue, then they can negotiate lower prices. But the thing is, they have to spend a lot of time getting this custom fix. They don't really want to move away. So those are the negatives. I looked at the 2 competitors. One's very small. I don't think Zytronic really has too many competitors to. They're very new. You can't really compare it to a big company that does so many different things. But just a tiny segment of that company actually competes with Zytronic. So this is the weakest part of my analysis, really understanding exactly how they compare to their competition. As you can see, during COVID, they cut quite a lot of staff, and if they're going to scale back up, they have to rehire staff, which may prove difficult to some extent. So basically, I've done a valuation here. I don't actually do discounted cash flow. That's the way like you're taught to do it in CFA. But for those reasons there, which I don't want to get into because I don't have 20 minutes, I've done a scenario analysis. And I have actually done a discounted cash flow yet to show you that it can be done. But basically, I have 3 scenarios. One is the good scenario, one's a good scenario, and one's a poor scenario. And then I've done a weighted average. So the data is. So in the good scenario, I think that things return to normal eventually for Zytronic. It might take a year or 2. I think margins will be roughly the same. I think they'll reinstall the dividends. When they do, dividend yielding investment will come back into the company. The trend line will be something. So EPS will be higher. I also think that, there's the possibility that with such a large cash balance, they could pay a large special dividend, or they could buy another business in this depressed industry and have some sort of post-acquisition or synergy, or they could continue to buy back. They've got so the share price stays low, they keep buying back, and then you'd have a great business. You'd have a big business. You'd have a much higher ownership in a great business. Also looking at, if I was a private equity investor, you could finance this quite easily because you've got 7.5 million in cash. They've got quite a big property portfolio there, so you can easily get 5 million in mortgage debt. So that's 12.5 million. So you can buy the whole company. It would be leveraged, but you pay how much now for it at the current price. So instead of being very attractive, I was talking to the largest shareholder. He said that there's a potential foreign buyer, General Cluster, that may be interested in acquiring the company at a premium. Especially since the pound is fine. Help with their supply chain, and there's a lot of synergistic benefits with that. So I've said that there's about a 25% chance that the market cap would be equal to about 60 million in 2 years. So I've just counted that using just a 5% discount rate, just kind of arbitrarily determined. I don't think that's unreasonable. If you look at the market cap of the company in the past, you can see that it's been higher than 60 million, it's been about 100 million very long ago, like 5 years ago. and not really much has changed. And here's an average. Scenario. You know, it doesn't get acquired. It doesn't get taken private. Doesn't. Nothing really special happens, and it might take a bit longer, but in a couple of years, things return to normal. I can't tell you exactly when. But I said the market cap is 40 million, which I think's fairly reasonable, and I've given that 60% likely. Now, the best part is the side. So, company's not going to go bankrupt, going concern, no debt, lots of cash. You know, maybe there are factors that I cannot see that have made Zytronic less competitive, and maybe it will just plug along, making a small profit. So I said there's a 15% likelihood that market cap is like to 12 million, which is what it currently is. I've discounted that. The company's really not going to go bankrupt. It's got so much cash, so much debt. The downside's very low. So when there's a distribution of outcome, a high probability of significant gain, but at the same time, more importantly, there's also increased of loss, and the loss is quite tolerable. So my thesis is that if the company is performing like it was the pandemic, I expect the share price to be roughly the same. Then I also expect the even slightly higher actually, because earnings per share would be higher. Yeah, 5 minutes, okay. I also think that because earnings per share is higher, it's going to give us the illusion of an upward trend, which might increase the valuation. Especially since it's been on this downward trend, it's going to be a reversal of the trend, and I think that's a good thing. I think currently it's too small to attract institutional attention, but I think if it gets a bit bigger, maybe the market will become like 70 million or something, it might start to, the bigger funds may start to invest in Zytronic. So basically my weighted average is about 36 million. Now it's trading about 13 million. You've got a large upside, like 200%. So here's the liquidation value, what I've done. It's rather simple. It's like a supplementary valuation. Basically, taken accounts receivable, adjusted it down by 10%, which doesn't sound like a lot. They've been very accurate in the past, and most debts are due within like 60 days or something. So, I've taken inventory. I said it's worth 65% of book value. I don't know if that's accurate. I've taken the patents. I said they're worth 50% of their amortized cost. That may not be accurate. It may be more, maybe less. So this property that they have, I've basically determined that it's worth far more than the stated act, because the stated act cost line accumulated depreciation. Property goes up over time, doesn't go down. So the net effect is that it's worth about 19 million, approximately. I don't have the resources to actually go to all the properties and get them independently valued. But I really like that, if the company were to shut down tomorrow, I might get 17, 18 million or something for the company. It's currently trading at 12. So to me, that's a good upside. So if you look at the ratio analysis, you can see that the company's been trading it's been trading greater than book value for a long period of time. That's since like 2001. So it's been, on average, it's been trading 2.3 times book value. Now it's trading at book value, maybe less. So historically, it's trading far below its normal multiple. If you look at how much management think the company's worth, quickly, they exercised some share options themselves at £4. It was back in 2017. There's been no subsequent options. And they've been buying back a lot of shares at £1.45, slightly above. So I don't think it's worth more than £1.45, but maybe slightly less than £4.27. So that's what they think the company's worth. If you look, the insider ownership's been increasing, but it's not too high. Still quite low, but I quite like it in that ratio. It's, less than 50%. It's the right type of number. It's like they don't have control, but they have big stake in the company. They're invested alongside me. Their interests and my interests are aligned. So that's a big plus. This is just basically proving that over time, value is better than growth. I don't, depends what time period you use or so on. But there's quite a few sources for it. I mean, to me, I'm just buying on the numbers. It's just like a cold, rational, doesn't have to be an exciting story or anything. Just have to be right. So here's all the financials. As you can see, profit every year since 2004, except for that, except 2020. Good, strong going concern. Average about 2.2 million per year. Revenue has increased really over time. If you look at the trend line, I think it's 5% per year. I mean, it's gone down recently, but growing. It's not the most exciting business, but we're getting bigger. Cash flow. They pay out 63% of their earnings as a dividend, so they don't just pull on the cap. So you get a good dividend return. I've basically discussed how much they spent buying back new shares. Also like the fact that they don't have options. I'm not a big fan of options because of the asymmetrical risk reward. If everything goes right, you get money as a manager, but you don't take any of the downside. I much prefer ownership. So why is a strong balance sheet good? Basically, it can be used to finance an acquisition. Also, they have no doubt of balance sheet financing. They have a defined contribution pension scheme. I really hate those defined benefit schemes. They pose a significant risk. How could that strong balance sheet translate into value? They could keep buying back shares. They could buy another company on the cheap. They could spend more on research and development. They could pay out large special dividends. Help in a takeover attempt. As I've explained, you can buy the company for basically nothing if you if you pay back the loan with the cash and then took out a big mortgage. I mean, the company is more risky, but you've got no equity invested, but you've got nothing to lose. So it also means that they have so much cash they can withstand multiple. They could have 5 pandemics at a time. Also means that they're not going to have to issue shares at the wrong time. Sometimes companies they get stuck between a rock and a hard place and they have to share at the wrong time. It also means that if interest rates keep rising, but then have to pay more on their debt. And because they have a large cash balance, if interest rates rise, they can then receive more interest income. So basically discussed. Basically, this is what they provided. Obviously there's some technology changes, and it's not something I don't quite understand. I really understand the science behind the touch screens, and that is a risk. They've also been in business for a long time. So that is an area of ignorance to me. I don't have a PhD in that type of thing. So I was talking about revenue concentration. It is an issue, but I don't think it's been like that for quite a long period of time. Companies are doing fine. I don't think we're going to have another pandemic. I think that's probably unlikely. There's in the financial sector, revenues may decline slightly, and they've been quite candid about that. It's not a huge portion of the business, and other portions are likely to expand. As I said, it's there are additional risks. They were not disclosed in the financials, but that I thought about. Basically, when you buy something from Zytronic, it only lasts a long period of time. So they don't have a team. You don't have a company that so they have to continuously find new customers. So it's not quite as easy to expand your revenue that way. Also, if a product becomes very popular, they can if they get a scale in Asia, then your payment's not really that effective. So it doesn't have Zytronic's not one story. It doesn't have revenue's not going to explode. but I think it's going to return to. The share is going to return to a price which is reasonable in relation to what's actually worth. Like liquidity risk, because it's a small company, you know, when you buy and sell, there's a spread for me. So that's a risk. You know, there's a risk that patents expire. But luckily they've got 6 new patents in application. I mean, they could spend more on R&D, and there's just one person who's in charge of I think of the invention, so that's why that's a significant risk. You know, also because they're an exporter, currency is important, but you know, as the pound has weakened, it means that they're actually more competitive globally. Obviously, their costs may have gone up if they're having to import, but then at the same time, their revenue will be higher, so it's a net positive. And as we discussed earlier, this market seems fairly valued. So I'm going to hold the share for a couple of years. Well, it depends. It really depends what, you know, what happens to the company and, you know, what happens to the share price. Like if it goes to £3, I'll probably start selling. Then I can find something else I can reinvent it. It really depends on how the company performs financially. And also what other investments I find. If I find something really amazing, like even better than this, then I might start selling this, buy something even better. So here's, this is just my free cash flow, which is just for disclosure purposes. I don't really agree with this stuff because it's kind of, I don't actually know what's going to happen every year, like no one does, and I'm not going to pretend that I do. But this also arrives at, you know, roughly the same valuation, about 35. There's just assumptions from my free cash flow. So I don't know if you have any questions. Yeah.
Sure. I have one. I suppose they've got one product and they've done very well with it. But is there a possibility that that technology has had its day? Something, you know, better will come along with AI or app-based things. Everyone uses their own, buys their own. Well, is there still going to be the demand for this console-based touchscreen? So that's the biggest threat that I can get of.
They don't have one product. They have actually many different products. Yeah. I think it's in my opinion. I think that risk is quite low. I think they have a very small market. It's niche. It's like you go there to get something really custom made for yourself. I don't see that being. I mean, it is a risk. I don't see it being a significant risk. It's not just one product. They have like 50 products. So.
Thanks for that. The results out tomorrow, and it's a great shout of the presentation on it.
Yeah.
So well done for that. I'm also a holder in Zytronic, but I believe it lost a big contract in 2019 or so to win the finals in vending machines for the season. And whilst I'm concerned it won't get back to where it's historically on the basis of our contracts. Are you aware of is there a potential for that to return? Or are you factoring in kind of pick up the business wise information from yes?
Actually aware that they've got that far. Like for example. I also don't know how significant that contract
Managed to refer to me.
Yeah, I mean, they can do the big contract, I guess, they can also gain a big contract. Yeah. I'm not, I mean, you are right. I'm just, yeah, right. Yeah, I don't have a prediction. I mean, that's why I know to some extent. I don't know everything, but if most Stanford is like Baylor, and I'm like, no, you're right. I mean, you've got to tell me wrong. I don't think it says open, but the me, it doesn't like pocket chats, pretty large. Like, I'm likely, it's still wrong, but I think when I consider the name of that, I think, about how much this was, anyway, futures not made in the future.
Thanks so much for the presentation. A few things that we've got. There's something before, maybe a couple of things further. I'm shredding with the available. I've got a couple of comments. I'm going to ask a few questions. So the first thing is I've done a sort of drive-by Google properly made it proper. And I have to say I didn't look in good condition. It was maintained physics. Ideally, it would be something that would become taking something out of residential, and I didn't see that opportunity. It is industrial, no, indeed. I mean, there's some water nearby. That are actually bigger steel.
So there's lots of other.
Yeah, there's lots exactly. Sites. And ideal work, we will schedule it in industrial estate. And they will extend that out in this extend.
You still have like commercial values.
Absolutely, it's got commercial value, and I said probably was well maintained and so. I think human valuation might be a belches anyway. Number of issues. Right. So my main concern here is really about one of the two of the business lines, and one of them is the gaming, the instrument for itself. You know, can I carry on with the line? Yes. So lots of the machines ended up in the killing. We don't know about this contract on particularly. How it's not my flavour of the month at the moment. Any kind of special treatment for special administrative regions in China, it's not a thing anymore.
It's definitely bad.
Yes, it's been bad. It's been bad. It's not been bad. Been bad. So to think that that's going to come back, I think that's very upsetting. Of course, there may be something else, but that's the biggest system. I'm not sure when the gaming site's going to come back. Second thing is, I read what someone offered, cash machine, so I would be looking at what the customers will come back rather than thinking of it.
I guess also, like generally results of the way, to get a lot of revenue, to get 20 million, to get maybe $7 there's also, as I said earlier, they expand into the window lower games. The areas of opportunity, even the audience, so they could use the Reitmans, and also be balanced by other areas, for instance. And also, I don't think it's a value business. It's not a growth stock.
So you've got any products? It's very nice. So
Yeah.
so you're not revenue generating currently.
Yeah.
And it's quite potentially one of those things.
Yeah, I personally don't know much. I don't actually. I was told by the largest shareholder that a very constant volatility. As I said, I'm not. I would take more time. From the different products, makes sense for the revenue that's been lost in other areas. It's like if revenue's been like 18 million, 19 million, 20 million, 21 million in quite a long period of time. When I see it's like, I play golf and sometimes, I shoot like 8 yards, because I'm full handicap. But it doesn't mean that now my handicap's 16. Like, yeah, my house. Right. So looking at the longer term track record, it's quite likely that revenue will be, it's quite likely that revenue will be roughly what it has been in the past when things, now that things are returning to.
I saw management listed that one of the key risks is key customers. Yeah. So do they mention any detail like who the key customers are? I guess that's not more explored so actual business customers. It's likely to have that aspect of the business well. So can you mention any key customers and I mentioned what we're taking
I was behind that if I'm helping you like for these receivables paid. They also didn't disclose the costs of certain clients. Because all about purchase forces, that would have been useful information. Really like that they didn't disclose that information because me as an investor, because I own a portion of the company, they owe it to me. So no, if you can find that out, that would be really
I don't understand that they don't. Yeah, I understand because they're always doing one-off projects. They don't ever have lots of repeat customers. So they wouldn't necessarily have. What's up?
Well, they might have they might have a big project currently with one customer that's like really £3 million, so it'd be a significant portion of revenue. That doesn't mean that the customer. It doesn't mean that customer is going to be a big portion of revenue. Yeah.
Yeah, so one customer is 20-25%.
It's useful then to the yeah, even more useful. Yeah, same customer.
Kind of almost outdated. So,
Is that enough time? I think I've overused my time. Sorry.
I think it was great because it seems that they enjoyed your presentation was very detailed and we usually get 2-3 questions after a presentation, but I really enjoyed that you all enjoyed it and it was a great discussion that you all participated, so I didn't want to interrupt you. Yeah. So Alex is an invaluable investor. Is one of the few people that I know that they really get happy from things. So it was a great presentation. So I will present a few diagrams. I won't make any very intense and deep presentation. I'll just present the idea. I like the ideas so much. I don't know. What do you think about the ideas? Is anybody that can take opportunity? Yeah. Yeah.
I'm interested to know if anybody like TGI Fridays in the restaurant. That I know. I think it's one of the worst restaurants imaginable. But when I do research on this, everybody I talk to, has anybody been there in the last year? No.
years ago.
Right, okay. But when I was the wider audience, a lot of people say, you want to go there. I didn't want to go there, but it was like the option that nobody objected to. So we all went there because they've got a wide menu and it's bland and expensive. And the main complaint is the price, which potentially for shareholders that we can still go there and it's no way. So this has been massively beaten down. So I think this is an example. Sorry, I'm talking too much. This is an example of an opportunity in the sector a company everybody hates, and so obviously institutional selling now, and didn't want it in the first place. Clearly their previous strategy of expanding was ridiculous, but they follow down the idea of going for cash flows, paying down debt, then there could be someone who still wants to directly buy. So there's an example of something that could be oversold, could be, or could be done.
So yeah, any other yes. So basically, retail is a sector that haven't performed very well. You know, many businesses that they have grown fast. So basically, one characteristic of retail is a capital light. You have a capital light is not to benefit no debt there. If you have 2 or 3 bad years, this can be the end for the company. Just 1, 2 bad years. Then, if you talk about fashion, it depends. What's the theme? But if you talk about fashion, it's so unpredictable. Starts 2 or 3 years, and then it can collapse. And all those are things that tells you that this is not the right place to be. And we know, and somebody could say, I don't know in relation like what has happened in history. If you look back, a lot of things, why you insist. So those are this is the bad side, right? It seems that we. Okay, give me just a minute. Yeah, so now the good side of it. The good side of it is that there is blood in the streets. When there is blood in the streets, it's time to buy. So when you have a capital-light business, you make it easier to go fast, but also you have high return on equity and high return on assets and grow. So for example, if you have 10 stores and you do well and you have some earnings, you don't need a lot of capital. But very quickly you can have these 10 stores can become 50. And we see many retailers that from 10 stores they want 500 stores. So it's two-way, right? And also the fact that they are predicting, also that you have operating leverage, you have things that they are predictable, but they can go two directions, right? I mean, we shouldn't forget the positive side of it. And now about learning something from history, because we value investors sometimes we have a character that we are insisters, right? Somebody says something else and what we think. I think we're insisters. And how come we know that we just don't insist in something that it's not a good idea? We just insist because of biases, because we don't want to accept that we are wrong. So here I think that a very critical question to ask is if what has retail is something cyclical or secular or this part of it. So some part of it, and generally I don't like retail. If you told me that the conditions were normal, I don't think that it should be a sector I would feel. But in this specific time, yeah, I think that the reason is that you had 2 crises. You had one crisis, which was the brick and mortar crisis that lasted for long, and then the COVID crisis. And now I think that the time is good for the survivors. So I don't think that retail is a good sector to be. But if there is one good time to be, I think it's now. Now that there is blood in the streets. And all those that they have survived, I think they have less competition. Recently, I went to an ATM of a company and they told me that they can prove that there is less competition, or prove that there is less competition. And now I'm trying to find in this sector good risk reward candidates. And what are the, because anyways, I'm somewhere that is risky, right? I don't want to do extra risk. So one thing is I don't want to complement this operating leverage with balance sheet leverage. So I go for low debt, or if they can be net cash, it's better to be net cash. Then I want to see some signs that they are turning around, or let's go for the retailer, but they are still in big losses, or they are not, that probably something is turning around. So I want to see that probably something is turning around. And then I want to get paid for it. So we go for a retailer that on a good scenario to do this, it will give me just 2x. So I go for extreme discount. And then I don't want a secular trend against their business. So as I said before, for example, if we go to stores that say sell electronics or things that probably the England has an advantage there, because I think somewhere we'll have an equilibrium. Internet won't capture everything. Something they will still have them, they will go to the stores, they will check for clothes. I don't think that everything will take over everything. That internet will take over everything. But I think that some sectors might have but fortune ahead. Some things, some specific places in the sector. So I don't want to be in those places. And of all, I will quickly present. I will try to be very keen. I want to simulate like a game. So like my favorite game, we invested this year. To check quickly a few metrics, even if I don't know the business, for the income statement, for the balance, and try to guess the market cap. I think that's a game. But even if you do it without having a lot of knowledge, it's a very helpful game to help you understand how valuations and why you are wrong. Because very quickly, do that before we check the comparison. So the game is that we will see a few retailers. I'll ask you to make a guess. I know you don't have all the available information, but one good part of this game is that sometimes the price advises. We see a company and it has a market capitalization of 1 billion. Things are terrible there. When the market cap is 1 billion, we say, okay, it's 1 billion and we have this in our mind, and we cannot think of very bad things. And then when the market cap is 50 million and it's the same company, if similar things happen, we have in our mind this 50 million and we say, this is God, this is not. First, markets are efficient and we should respect them, but it's always nice to try to guess. We won't have all the available information, but let's play this game. So let's start with this. You know this company. I hope online you can see the numbers and everything. So this is a retailer. They struggled a lot during and before COVID, and now they are coming back. And basically, they consumed at some point all their net cash, and now they have gained back their net cash. They have 9 million of net cash. The revenue has increased, and now for the first half of the fiscal 2023, they have gone back to 49 million. So they will finish probably the fiscal year somewhere close to 100 million revenue. The net income maybe is a bit lower than the cash flow that they have, but they seem that they are turning around. So I don't know. Here you see the description. They sell. They specialize in occasion wear, and this is the company that I went to the AGM. So what do you think? What do you think in your wide guess about the market? What do you think an acceptable fair price to 30 million? Yeah. like you say, okay, I accept the risk, it's retail, but if it's less than 30 million, I will pay it. Yeah. And any other, just say that.
Well, 30 million, I'm looking at the long-term trend, made about 6 million, 4 million profit. That's quite a significant net income. So, even at a PE of 5, that's 30 million, if net assets 20 million. So it's like premium above 20 million because of a significant profit from the branch. So, but also, clothing. I think clothing is less likely to be selected by online users. People like to try on clothes. Not something you wouldn't buy clothes online, really. Don't.
So I is the what is gaining a lot is the online channel. So businesses that they can offer online and they can offer on store, but they have those two work together. But generally, what we see after COVID is that all those retailers that they are in the physical space, they have started to return. There is much competition on the internet side. Any other numbers now? Yes. That's part of the retail, like that's when it does well.
Yeah, I mean, normally I would say clothing, physical retail is a really bad place for me. The specialism in occasional has, I think, gives them some stuff there because someone's potentially going out to export to Milan and that kind of thing. So I can see that. But I wouldn't really be wanting to pay much more than net tangible asset. So I would be saying 17 million based on that. But I didn't realise, I vaguely know the company, I don't know, so I'm not sure to. I was surprised how much cash they have to. Yeah, it's good.
You have to compare with when they have like 100 million of revenue. Yeah. Yeah. It's not much. That's not. So should we reveal the market cap? So we hit the so right now it's 21 million and the company trades for 15p. It used to trade at 5p, but when it was at 5p, it was a lottery. Now I think it's not a lottery. The probabilities are. But even when they have announced the revenue, like a few months ago, it was still trading at 12 pesos. It was, I don't know, 14 million or 13 million. So there it was even a bigger opportunity. So now if they do well and if they later on, if they go for 5, 6 hours, but you see there when the market got, or it was the IPO and all this, excitement, the market called it the evaluations of the and you see if they start, if the revenue start picking up, it goes to 100, 120 now, and then the market might think that's the same in the future. And also you have this momentum, you should think that from 5p they see a stock that goes 20x, and that creates this. I have to say here, and it was also on the presentation, but we are free to go. And we say our opinion, but our opinion is never a recommendation, and that's how we feel free. So, and here is a place that we can talk for free. We listen, we judge, so you never. Alex has his opinion. We are thankful when he comes and says everything, and we always do our research and we never blame anybody. Whatever we do here is not an advice, so we are not recommending anything. But we personally love. Now, the next one is, I think this one is bigger, probably Or if somebody knows already the market guide, they shouldn't see it. Okay. Once figures or so basically I can say a few words. I don't want to overpresent them. But basically these are purely online. These are pure and they have 3 brands. And one bad part of this company is basically they get a lot of revenue as financial services revenue. So basically, it's from it's credit for the customer purchase, which is not if you see it from the client side, it's not the best. Basically, you do something which I think it's not socially responsible. You may get money out of it. I don't think it's socially responsible, the model. But it might bring you revenue. So it has some, and basically we take advantage of those people that they are weak and they go and buy in debt. And here and there, they also pay the price of that because they have to write off some of their of what they owe to them. But I can just tell you a few things that their net debt is only 250 million, which somebody can say that that's a lot, but you have to account that most of the receivables is also their what the customers owe to them, and there is already a discount there for bad debt. So basically, you can see that total equity is 440 million, and intangible assets are only 100. So 300 is tangible book value. And according to that, what would be like a nice price for you? A fair price or a nice price? Free to talk, like you, with the information that you have. Yes, thank you. The most brave.
Okay. Again, I don't know what the one Canada they've seen. I just point out that Next, which is a very well respected company, also has debt on its balance sheet. It has. Sorry, it doesn't have debt, sweat maybe, but it has some. It lends its customers money into its balance sheet.
That because sharing it's one term.
I don't know for Next, but it's bigger than the average retail because historically they've had Next Directory, which has been a lot of sales.
I think that for them is their main model. It's absolutely their main model. That's why it's one third of their revenue is just leaders.
Yeah, so there are good quality companies. I think everybody agrees Next is a quality company and this is not. So the difference really is the customers and how they're going to be affected by the cost of living crisis, both in buying new, more clothes, and also by whether they're going to be able to keep up with their repayments. So I would like to see that trade and other receivables split into split down. But my guess would be, I'm going to guess for 300 million. Yeah. Well, hold on there. No, they've got a lot of intangibles on there. So I'd like to write down the trade and other receivables a bit because of that. And I'd like to put a copy intangibles. So 250.
200 million.
And I've got a vague feeling it's much less than that. But 250 sounds.
So the missing piece of this balance is the debt figures. And I think this company has a lot of debt, what I know about in the past.
It's there, it's just a net debt. It's 200 to 450. It's up here, 250, around 200.
So its operating profit is probably 30 million a year. It's got 8 times leaving. So it's going to be on a low market cap, I reckon.
Yeah.
So I'd say it's not going to be on a tiny multiple, exactly, but it's going to be on a FE of 6. So I'd say it's got a market cap of 20.
Any other ideas? Just some number. No.
What? Those that.
I guess I guess that because it's now I don't remember, but I guess that because it's an internet business where many of them might be not just brand or something because they might have extra software.
They've got free brands. They've got one of those things, right? So
Something might be brand value, but also there is an online retailer. So I guess that if what they have, this intangible value brings all this.
that's goodwill. It's not worth it. It's like there's a chance that the numbers could be worth more, but
But anyway, it's not a huge amount. It's one half.
it's like listen, I sell it's worth a fortune.
I know we don't have all the information because anyways, for reason it will take 2 hours per. But let's review the number, right? So it's right now it's yeah.
That's legitimate.
Yeah.
What's the debt structure? Kind of. Is it fixed rate?
I think
It's short
I
term.
think it's based on their group of so it's something like that.
Right.
Yeah.
And I see they fix
So they should because that might be something.
yeah, because they could, well that should be it. That should be on the balance sheet.
Let's also do that. It might be something that might happen. That's a very good point. That's a very good point. Let's go to the next one. But these are like also it's like examples of what you can see in the execution. It's not a deep analysis, but they're examples of valuation that we can see. So this one is more well known. So I don't bring a lot of things. I will just say that now, I think it's an amount of around 70 million is a credit facilities, but they are about to renew it. It's not certain that they will renew it. So there is a lot of speculation. It's not clear that they have turned around because when you have a business, I'm just giving you some background there. These are very marginal numbers, and they can play with, potentially a business in terms of presentation. So we don't really know, like, these are really marginal. It could be minus 10 or plus 20, 600 million. It's really marginal. So it hasn't even turned around. And when they have some debt, which must be like 60, 70, they're really things. Of course, it's a well-known brand, and it's my opinion is that if they have worked during good years, and they can and they will be able to repay or reduce this net debt, I think then they will, and they go back. They could go back to 40, 50 million because I don't think that it can be a business that will stay in 10, 20 million. They would either struggle a lot and probably go bust at some point, or if they return to normal, at least they will have 40, 50 million of net income. That's my guess. So I don't know what's the possibility, but I'll do my guess according to that, and I really worry about what will happen with because we might have a capital raise, you might have, those things are very sensitive. Any guesses for okay. They have, yeah, they just but did I tell you what the claim facility is around 60-70 million? Which is intensive. Reality, let me see if I have. I think for this one, I didn't put more.
The exception, when the exception doesn't mean best income bonds, or is that genuine losses?
Where?
So the two big negative bars, they're exceptional. I write off these like
I think there should be also exceptionals, yeah. But then, you had COVID, you had. Okay, if we don't have enough data, but what would be, according to what I told you, like this method, they can survive or they cannot survive, what would you go deeper? Let's say you see that. What would be the market cap that would tell you, you have to check better? Like, I don't know yet. If it's lower than that, I should go and check better. Like, something like that. Which one is this question? Do you like this game? Anybody else? Something like that. So right now trades are on 85. That's 85. But that's the thing, when the people see 85, they say they know to be 40. But yeah, it's a dangerous zone. Time goes down. Risky. It's fun.
Yeah, also worry. I know some of them are small, so you won't find options, but it makes sense to me. You know, if you're gonna, if there's a high chance to go broke, you're gonna lose everything with the equity investment anyway. So you may have, you know, an option you're gonna lose everything. You just want to make sure it's a long-term option. But then on the upside, if you have an option, you'd leverage your, you know, your 5 bag over might be 25. So, you know, 25 maybe. So if I was pursuing a strategy, if I could find options that were reasonably priced, I might have a faster option.
Joe Ripper has talked about this, and it's a good idea because you either win or you either lose. So anyways, when you lose, you lose 100%. When you win, why not to win more? But here, what I don't like in options is I don't know if they're always. Sometimes they're expensive, and also I don't like that. I like to have a lot of them, and I know, but sometimes you may find options good years. I don't know what happens in the UK, but generally 2 years pass very quickly. Initially, you have the idea that it's an option, but from whatever investments I have done and the successful ones, sometimes it takes longer. So it seems that 2 years is long, but it's not that long. And so if I had an option that was reasonably priced, it was for 7 years or 8 years, yes, maybe okay, but 4 or 5. I think 2 is very. I don't feel comfortable. Yeah, that's how I think about it. But I think for
And we really have a bias to, like, the one thing we can predict, like, we can all, one of the things they can identify with this, and I think that sometimes, I think often they're wrong. I mean, it's really looking for, like, initially it started with nothing. Really, income and revenue. So, it's not really such a bad business. I think, you know, people are too focused, too narrow-minded, and they just look at the most recent year or the most recent 2 years. They don't really look at last time with the 10-year or
that's this one. First, I'll tell you that something. An important factor there is that you can remember exactly the almost, I think it's 25%, I'm sorry if I'm wrong. Who is the founder, left the management and then returned back. And I find it important because you have the person that has the DNA, the founder, and he sees this as his failure, and he will do everything. And the other thing is that in all those low capital businesses, when something goes wrong, the management, if they feel like maybe they are creditors or and things are not going well, they will just, I have seen, especially in the UK, they are not very large shareholders. So that you have creditors, they take over the company, and shareholders just very easily accept that they go for. But if you have somebody who has like a significant shareholding in the company and it's a big part of his life, I think he will do everything to defend it. So that doesn't exclude that if they don't trust him or if they don't trust the turnaround, they don't have any tangible to secure their debt, this thing can go bust. But I think that the leader there, in that case, he will do everything to save the company, which is a big plus. That's what I think. It makes it even yet. I think
probably everybody here has some feeling about Superdry and the brand's dead. But I think it's important to remember that the world's a big place and we might not be aware of the cultural, the way it's perceived in other cultures. I mean, I think Burberry was a good example of that, where it was a completely devalued brand in the UK, but it was still doing very well in China.
Yeah, and I see many people, I don't know, from Indian places that they see Superdry in a different way, and probably, yeah, but what you said is very true. So should we go to the next one? That's again, it's even more killer. So there, again, in those last, I didn't put a note, but I just put the net debt excluding the leases, just to have like an amount of like essential leverage. Again, not all the information, but I didn't want to put too much information for a 2-3 minutes presentation. Any thoughts here? I mean, you know that, but I think it's something, my opinion, something so stable. They struggled for a few years. We see here that they struggled for a few years. But my best guess is that they will return to their normal. Probably sometimes you have some struggling as a retailer. They are very stable in revenue. You just downsize a bit, and then I think you return to your. And I think this is well noted here. So I believe they will return to that. They will keep this 300, 400 million. That's my best guess. I don't know. What do you think?
Not the biggest fan of success, music, both are okay, but then their food is a bit nice. It's not actually, it's not the same quality as Waitrose, but it's,
I don't think it's
yeah. I don't know, I've been to this Oxford, all of us have been to Marks and Spencer's, it's just, I don't know, I do see them as like at a competitive disadvantage. That's because I shop at Marks and Spencer's and I've been there quite a lot, so I probably, much lower valuation for Marks and Spencer's.
So according to that, what would you pay, or what price would entice you? So it's not your favorite, but what price would entice you to look further and say, because there's, I think in a surviving company, there's always a price on something can be enticed. Like maybe it's not our. Any thoughts? Just numbers. Say numbers. I'm happy to give a number.
I'm always going to give a number. I mean, we haven't got a balance sheet here, which would be my starting point. What we do have is net debt 628 million, excluding leases.
Yeah.
So obviously leases are very important. They've got a big estate, including in 6%. If you look at that graph going into COVID, it looks like they were going in anyway. You look at what's happened afterwards. I don't know the business, but it looks like there may have been some temporary bounce back there. If you were to give me a rounded percentage of sales, I would say sort of around 0% of sales would be my value. Now, clearly, it has option value. So clearly worth 100 million, I would think. I don't know. Yeah, no, maybe, yeah, okay, 50 million. It's definitely got to be worth 50 million for option value. That's yeah, and that looks like that was the most in 1, 2, 3, 4, 5 years. I would need to see that profit figure and see what had been written up, or maybe it was write-ups from reversing write-downs from COVID. We saw lots of people writing down intangibles and leases and then writing them back up again. I'd be very suspicious of that value without any more information. So, I mean, it rounds to 0 would be my valuation. Somebody wants, I say, yeah, you want to write a video. So,
Yeah, no,
it's very instructive. Because I get question millions. But yeah, if you believe so much.
That's 4 times current.
Let's see.
It's very low. It's quite low. I don't think like.
So it's 2.3. If they return to their past earnings, 300 million or something, and if we consider that there is no significant net debt, it's the P is lower than 10. So yeah, but if what you say is true, and if you think that probably 2 billion is too expensive, if it's kind of, I don't know.
Show me the cash flow.
Cash flow. We can check later, okay? We can check later. That's a good point. Okay, now I'm just presenting 2 other names that I have seen, and they are extremely like the market caps are extreme. But you can go and check and have all the data. I won't tell you to guess. The one is Canadian. I don't know a lot about the company. So sometimes when I don't know a lot, if I find something that it might be very cheap, I might get the very first position. And there, where I find this Reitmans interesting is that they seem that they are turning around. And because they were floating backwards, and the stock was close to zero, basically. Now, the stock maybe has gone, I don't know, 3, 4, 5 times up, but it's still cheap. So people might see that and they say, no way that it can go more, it has already tripled or something. But there, I think, is an opportunity because if you just go and check the market cap, but I haven't done deep research on that. The other is a British one, very small cap. They, in open spaces, in malls, they have promotional spaces, and it's a very, very low market cap. Now, during the COVID, they have accumulated some net debt, so it's very risky. But the market cap is like an option. So you can go and check them. I'm just telling them as I'm not asking you to guess. So, yeah.
Based on the name.
Yeah.
I like.
So, is anything else like we will have like a small discussion as well for sources, like sources that you use. I will present you with 10 value investing blogs that I personally find as the best, and I wrote an article and we published it on City Falcon's blog. Yeah. And then from there, you'll tell me if you know the names. But before that, if you know any sites or any blogs, until I prepare the presentation, you can talk about sources that you find interesting.
So I quite like going to research sites like Edison or Progressive or there are other ones out there. I like it because the companies are also trying to engage with their investor base and they're trying to get research out there. It's paid for by the company, so you have to treat it with some quality. So it's generally a positive. Just because the company is trying to get its engagements out there, and the research is normally okay quality to put this paid for and then to try and win new business for another client. So it's relatively decent quality.
Yep. And you any other Alex?
Value investors quite comfortable to have a lot of
Value Investors Club.
Yeah, it could be. Yeah, I think it's Value Investors Club, and there's also another site, like David Dodd and Gray and some another site there where they publish ideas. But to be honest, I don't really actually look. And I don't really like most ideas most people. I don't know. It's the numbers immediately they're not like me. Like really expensive. So I don't really rely too much on. Like if it's a big investor, so I might like Charlie Munger, like a big stake into the other founding, so they're like already in that position. Not because I respect him, someone's written like
and ask them about who they are, and I don't know what they think so. It doesn't inspire a lot of confidence. And, yeah, I will never do my own research.
I can show you some names and you can tell me if you know any of them. Right?
Yeah.
That might remember something. O'Brien, Childish O'Brien.
Yeah.
He's a very good teacher, but now he mostly presents on YouTube, and it's like a vlog. But I think he's very funny, and yeah, he's very good.
I think it's my favorite in this. Maybe I took Charles.
Howard Marks, yeah, the memos. Who knows it? Yeah. Do you know Tobias? They also have a podcast every Tuesday, and they talk about value investing. About that's also an interesting one. Then, guys, I'm telling you, this is a small one, and it doesn't post so often. But I'm telling you, in terms of quality, it's in terms of a blog, because it's not like a famous, like, I don't know, Howard Marks or, but it's exceptional. If you go and see some of the blog posts, I think you will get impressed. So he gets just an idea, I don't know, diversification. And then he goes through all the quotes, all the books, all the great investors, and you get and says like and you can get like all the different ideas about diversification. Some people say diversify, but why not? And he gets all this idea in such a good way, so that the posts are very long, but they are so dense. So if I see something like that, I want to spend like 20 minutes or more. So I say, oh, I want to read if I see something posted there. And I guess it's not something so famous, but I really recommend it. It's not a stock, so I can recommend it. Yeah. The Value Investors Club, which it's kind of a blog. It's not exactly a blog. Value and opportunity. If you subscribe, you always receive great links and other great links to other great blogs. And Sven Carlin is a YouTuber mostly. Do you know Sven Carlin? So yeah, I like his ideas, but I think because he's a YouTuber and he wants to present as much as he can, it's like it's like the way that I presented you the retail stocks. No balance sheet, just 5 numbers. So the analysis is not always deep, but sometimes even from this type of analysis, you can get ideas. So I like it. Then the motor, I don't know. I know that generally is one of the best and more scientific books in valuation, but personally, I recognize it as one of the best. But personally, I'm not, according my style, I'm not a very, very big fan, I can tell you. But I included it because, objectively speaking, yeah, I think it's great. So yes, I included it, but personally, I think that sometimes when you just overdo it with calculations and everything, you lose the essence sometimes. And the most difficult part is to make the right assumptions. Even if you tell me how a business, if you tell me what Superdry or M&S will be in 5 years, I don't need to do Excel or this calculation to know if I buy an opportunity. So that's my. You can learn a lot because sometimes through the numbers you can see how things evolve and take businesses in ways you haven't thought. So it's a good place. And then a UK one. From this blog is the graph that I present. And then also it's another nice one which talks about quality of this. This is from the quality side. And because I'm very mechanical sometimes, or look at the numbers, like the cheapness in the numbers, sometimes I like to read something that it's more on general quality, like Fisher style of investing. And here we have like an ad for our Value Investor Club, which also has a Facebook group page, and there if you like the discussion that we have now, and you online, you can always come and we can talk there. You can post. I don't know. Do any of you have any blog or do you? Okay. And here you can vote online. You can go and vote, and you can vote for the best. So I don't know if you want to share any other sources or any thoughts on what we have or what would you vote for? Just to share about sources about what you read, what is your way of reading, your way of doing it, reading just annual reports, taking ideas, your way of finding for it. A very relaxed conversation about it.
Why are you giving it to me? Do you think I might have something to say?
Because you always it's great.
I'll start off. Okay, so this list, a lot of this stuff I don't read, and the reason I don't read it is not because it's not great, it's because I'm a UK-focused investor, and it's very international list, with the exception of UK dividend stocks.
Should I ask about you here in the UK?
So, I mean, in the UK, it depends what kind of investor you are, but if you're potentially taking advantage, if you're relatively small and you want to take advantage of that agility that you've got and the apparent higher liquidity that you've got, then I think you should definitely be reading the full stocks small cap value report, which you have to pay for.
Okay, I will write it down.
As part of Stockopedia. You might agree with him or you might not agree with him, but he's always entertaining, and additionally, he's got a big following, so I think it's important to know what other people are thinking. So you'll often see the price, if you're trying to pick your moment within the day, you'll often see the price move after you post something, so I think it's definitely worth reading.
Great.
It's on Stockopedia. You have to be a subscriber to Stockopedia, and then it's that value report. So it's quite expensive. I think it's $200 for the company, but you get some other stuff. Maybe you can make him a better offer, and he'll work for the So I don't tend to read blogs, but I will read books, and I take a bit of a different approach. I'm a UK equity investor. I find that UK is just one part of the world. It's a global, the companies are operating on a global sense. So I don't particularly want to restrict myself to just UK content, even though I am primarily a UK investor. So I would highly recommend 100 Baggers by Christopher Mayer. The other one this is one circulated, is Nick Sleep's document, which is he only sent around to his own investors. Can you get hold of that? Highly recommend that. It may allow you to step back, see how people code in different market environments, and makes you think when you're in a really tough points in markets, you're getting worried about your own portfolio. It does make you sit back and realise, well, everyone's been curious, even people who have fantastic returns, you've always had to do this. And so reading those sorts of things where if you go back for like 12 years, it's a bit like reading Warren Buffett's papers, but it's written by somebody else, so you have a different perspective. I just love reading. When someone's written a book, there's a lot of thought into it. It's not like a blog post where they might go back for a week, but a book is like, what they've done about for years. So it's
Yeah. Talk about it, said the dream of a portrait like that. That's really true. So it's like, it's what that's really good. So the interviews like big investors. It's fantastic. In terms of methods, it's probably like a lot of like rich fund methods. GMO, I know Jerry Grantham, really famous value investor. He's like one of theirs, maybe like for 10 years, obviously. He's content very good. He's someone who's been around, so he's been invested since the 60s. So yeah, he's that. That's a GMO, you get really better. Other than that, it's generally big hedge funds, various funds with equity, some of the biggest ones in the UK. They generally provide just market based I guess I'm in your head. I must refer to read books. I think there's a lot more. Not just got into the. I find my time is valuable. If I'm reading something, I'm really going to gain something from it. I say for me, sometimes it's not really like a particular stock, it's more like I read a lot of Ray Dalio and he does like macro analysis, and that kind of gives me areas of vision. I think it's China, so sometimes it's not giving me like a stock, but it's giving me sector or areas focusing. Often it's not stock idea, but it's a thought process. Like it's an idea of how to invest, which I can like incorporate into my investment philosophy.
One thing is about the market backers, these 100 backers. So I always wonder because it's different to have a 100 bagger in 5 years. And it seems impressive, but then a multi-bagger can be an index, or even if you circulate different stocks, because if you put this 100 bagger through 30 years, you have to calculate it in terms of annualized return. So if it has an annualized return of 15%, if I get 15% by just circulating big value stocks like Zytronic, so basically I can get this 100 bagger in a similar way. So there, I think it sounds, because always 100 bagger sounds great, but then it achieved this because then it became 30% of your portfolio, 40% of your portfolio. If something else was 40% of your portfolio, it might produce something. So this is the one thing. And the other is that what I like in Sleep's letters was that the transformation from a value investor that gives some weight to quality, to say that quality matters more. And then, after a point when he picked he said sometimes quality is worth whatever price. And I really wanted to talk to him because I can understand the logic of it, but again, even when they pick those great baggers, they don't increase the returns. So Buffett, for example, of course, they are bigger in size and they cannot use these old tricks. And I could never understand how they can stop thinking of the next opportunity. So I can understand it with my mind, but I cannot get in their position. It's like you don't want to get ready. You can understand the merits of it, but you cannot feel how it is. And one day, I don't know, you feel it. So what he says in his letters, I can understand it, but I cannot feel it. How somebody can go to that person. And just one last comment. I think that when they talk about this diamond that it's close to Amazon, basically they talk about diamonds that they are certain, almost certain that they are diamonds. They know, and they find those diamonds that they know that they are diamonds once per 10 years. I think that people read their books and their thoughts. Basically, they are 30-year experienced investors who know that now I found a diamond, and this is the diamond, and I know it. And I think it's not that easy. When I think that people take those words and they apply it and they say, I found the diamonds, and they find the diamond every year. And those people, they write about those things, but they find the diamond once per 10 years. So I think there must be some screening that this thing that you can pay whatever price is very rare and not rare. Those are some of my thoughts, but it's a great, and I'm happy that you reminded me. Yeah.
No, I'd like to say this. In my opinion,
It's easier to start as a value investor as you become more knowledgeable, just like Warren Buffett, he started buying cigar butts. But when he was doing that, he was making 50% a year, which is a much higher rate of return than he's making currently. It's a much easier strategy. Obviously, you can't scale it, so you have no choice but to become a growth investor. But for me, that's a skill that you acquire over 20 years. It's not something a novice can do. I feel like a lot of people kind of skip out. They skip the initial stages and they think they can identify a gem. It's actually really quite tricky to do that. Sure. I think it's probably fair to say that the current market environment is a little bit of cigar bit stocks than they were in the last 3, 4, 5 years. Certainly in my usual micro cap. So it's easier to say that, but there aren't those electronics around. Each of those retailers are cigar bit stocks, but I think people forget return on capital. We haven't really talked about return on capital this evening, and that's the difference. Buying a stock that consistently have a higher return on capital. And the sad fact is that US businesses or Chinese businesses have a much better chance of that. They've got the markets, they've got the scale. UK businesses have only got a certain amount of time before they get to their market limits. I mean, think about growth stock, Think about growth stock is when you pay a high multiple, if you're not accurate on the growth, it's quite easy for the stock to fall 80%. Because if you're paying 5 times book and it's trading at PE at 40, there's been trends where it's been growing 15-20% a year. If there's a year where revenues and profit decline significantly, it's quite reasonable for the stock to decline 80-90%. But if you're buying the value stock, unless it's highly leveraged, you're not going to have that. People always focus on the profits, but I think it's actually more important to check against loss. When you make a 50% loss, you have to make a 100% return to break even. So, taking the downside, as Warren Buffett says, first rule is not to lose money, and then don't forget the first rule. So, that's my.
Also, if there are any questions from the Zoom, I'm now checking on the Zoom. I don't know on the Facebook if we have this ability or if there are any questions there. But if we have any questions on Zoom, people that they want to ask something or say something, because I see some comments here that they are happy with what they say. They're happy with the quality of sound, but they're happy with the content of our discussion. And just want to check if we have any questions.
Like tennis, because 1 5, not 3 tennis.
Yeah, this is the
I almost like have to say one of these. I know it's really something. Nothing. And also,
I think on Facebook the comments are not going to.
place could be, oh, I think you just need to get a good idea and I can just sit. This is easier. But it's not.
Guys, we can keep the discussion or we can close the discussion and not just drink and stay there. What do you think? Do you want us to continue the discussion online and officially, or we should close? Not questions, because most of the people call us on Facebook, I think, and the comments were not over there, but on Zoom we had some comments.
I'd like to say one thing about the 100 baggers. If it's a 100 bagger, it's easy to keep it. But a high growth company is trading at a high multiple. Now, when it becomes like 20% of your portfolio, you're going to start to trim that position. When it becomes 50%, and you're going to start to trim that position, or are you going to start I would start to set it down if I wouldn't really actually get the 100 bagger. Yeah. And if you don't do that, you might get 100 bagger, but your risk-adjusted return is not anywhere near as good as rotating like that. Anything else?
So I think now that we should close the discussion here. Thank you for coming. We will continue dreaming and talking in a relaxed way. And thank you for attending us. Don't forget to go and visit the site with your share. Because you will see that the content that you get there are also some new tools like the insider transactions tool. And we are doing more and more to make the content more relevant. And we really think that we offer value for investors to find relevant content, easy content for the investments. And we are building more. Thank you for attending and join our Facebook group as well. Okay. Thank you, all of you.